To discuss Witan Investment Trust's full year results for 2020 and to get some insights into what investors can expect from the portfolio in the months ahead, I'm joined now by Witan's CEO, Andrew Bell. Andrew, thank you for joining us. Let's go back to the start of 2020. It was a really volatile first quarter and it was a tough time for Witan as well. But what's performance been like since then?
Well, as you know, Forrest Gump said, life's a box of chocolates, and you position yourself for the world you expect is not always the one that you get. So when the pandemic tipped the world into recession in early 2020, our portfolio performed quite poorly in the ensuing stock market turmoil in February and March. From May onwards, performance stabilised, and we outperformed very strongly in the second half of the year. That wasn't sufficient to overtake the return on our benchmark, which was just over 9%, but we did finish the year with a positive NAV total return of 4.2%.
So what were the reasons for that improvement in NAV performance?
The reasons were partly external and partly down to our own efforts. The external one was that the market pessimism at the end of March was clearly overdone, and we benefited from the subsequent calmer appraisal of the prospects as people got a better handle on how the pandemic was evolving. In terms of our own efforts, we reviewed our manager lineup and we made a number of changes which had the effect of reducing our exposure to the UK and Europe and increasing our exposure to the US and to faster growing economies such as emerging markets. Also, importantly, we retained some managers who'd performed poorly in the first part of the year, such as Artemis and Lansdowne, but where we felt the prospects for recovery looked well grounded, and they have also contributed.
Well, you mentioned some manager changes. How has that altered the portfolio characteristics of Witan? What was the difference, say, between today and the start of 2020?
There were two major changes that affected us in early 2020. The first was that we adopted a simplified benchmark which had a significantly greater weighting in the US and lower weightings in the UK and Europe. And the second was the impact of the pandemic, which accelerated many of the established trends towards remote working and online shopping and entertainment. And that had the effect of favouring technology services and other internet sectors that were exposed to those trends. We were initially too slow to adapt to those changes, but we made a number of changes during the early summer which had the effect of increasing our exposure to the US and faster growing companies and reducing our exposure to the UK and Europe. And the effects of that better balanced portfolio came through in the second half of the year.
If I look at Witan Investment Trust, the portfolio overall, roughly speaking, is about 65% global equities, 10% UK equities, with 25% in specialist mandates. Could you talk us through why a quarter of the portfolio is in specialist mandates and what some of the characteristics are?
Yes, the 25% gives us exposure to three areas where specialist knowledge can help portfolio performance. The first is regional managers, which aim to drill down and select the best investments in a particular region that we may be optimistic on, which at the moment would be Asia and emerging markets. The second area, which we've invested in extensively over the last 10 years or so, is investment companies which look at more specialised areas such as listed private equity or biotechnology, where opportunities exist which would usually be bypassed by conventional equity stock pickers. And finally, this area gives us the opportunity to invest in specialist sector portfolios or themed portfolios such as technology or climate change.
2020 was notable for the number of dividend cuts from companies around the world, but Witan has just increased its annual dividend for the 46th year in a row. Can you talk us through the dividend policy and how you're managing to fund it and how sustainable is it?
Our policy is that we aim to grow the dividend ahead of inflation to give our shareholders a reliable and growing income. And over the past 10 years or so, we've increased our dividend at a rate of over 9% a year and been able to add to our retained revenue reserves. Of course, 2020 was then a reminder that the past is not a guide to the future, as there were widespread cuts in market dividends, which we were able to offset by drawing on those revenue reserves and increase our dividend by 1.8% in a year when many companies cut their dividends. Now, I just emphasise we are total return investors, but delivering a growing dividend is part of what we aim to give our shareholders.
One result of the COVID crisis is we've seen discounts on investment trusts widen out, including on Witan. What have you been doing to address that?
Well, discounts are affected by general market conditions, but they can also be viewed as a bit of an opinion poll. If you have more people trying to sell a particular fund than there are new buyers available, the discount will tend to widen over time. And during 2020, our discount widened, and we responded by buying our shares persistently in the market at a discount. Because if we're able to buy our portfolio for less than its underlying worth, that adds to the net asset value per share, and it will act to reduce the discount. When you have periods when sentiment is wobbly, such as much of 2020, discounts tend to be wider anyway, but performance and companies' actions in the market also have an effect, and those are the two things that we're focused on.
One thing that Witan spent a lot of time on in 2020 is environmental, social and governance issues. What does that mean in practice, and how do you think that that's going to help shareholder returns in the long term?
We've always wanted to ensure that our managers take full account of the risks in the investment selections that they make. That's an obvious check that we've engaged with them upon over many years, and that when companies fall short, whether in financial terms or in terms of corporate behaviour, that they press for improvements. From our point of view, investing in well-managed companies with sustainably growing businesses is the foundation for delivering good returns for shareholders, as well as a better future for the planet and its people. We see paying attention to sort of ESG factors as being intrinsically bound up with delivering good returns for our shareholders. And as an example, the 3% we have invested in a climate change portfolio last year outperformed all of our other managers.
And finally, Andrew, you write in your review in the annual report that 2021 will be a year of reopening and recovery. How do you think that's going to be reflected in global stock markets and in the portfolio?
Well, 2020 was a year of disappointment and obviously crushed the hopes of many people. But as it went through, many companies adapted to the changed circumstances, and the benefits of that evolution will persist into the recovery. There should be an improvement in productivity. At the same time, medical science has been able to deliver effective vaccines in a fraction of the normal time that it's taken historically, and those seem set to enable economies to open up this year over the coming months in an environment where interest rates are at historically record low levels, and there's a massive fiscal stimulus being delivered in most major economies. So it's quite likely in our view that we're going to see a major spurt in growth during the middle quarters of this year, and that may be discounted by some sectors, it may be not discounted by other sectors. So selectivity is probably required, but it seems to us right to be optimistic about the reopening of the economy and the renewal of social and economic life in its wake.
Andrew Bell, thank you for joining us.
Thank you.